Forbes India Cover Story podcast series in association with theindicast.com. My name is Abhishek, and this issue's cover package is an investment special which talks about the various avenues that we can consider to park our savings and hope for a decent return. Because these are not regular times, the context is a slowing economy and the global coronavirus scare. Joining me on the talk is Salil Panchal. Hi, Salil. Nice to have you.
Hi, Abhishek.
Salil, in your story that introduces the package, you start off with the title Panic and Pain, alluding to the unscheduled interest rate cut by the Federal Reserve last month to support a
Yes.
slowing economy. And then, of course, you have the COVID-19. The global economy has suffered big time, so not very encouraging times then.
So you could say in terms of investment, this is not really the time that people would want to think about where their money should be parked. There's a flip side. This is probably the best time to start thinking of where to park your money. Whatever had to go wrong has really all gone wrong. You could talk about a scenario where the global economy is definitely undergoing a slowdown. We've been seeing that over the last more than a year. Domestic consumption very, very low. India is still looking at 7-year lows in terms of its GDP growth. And then you have, the coronavirus breakout. Extremely uncertain times. And considering that all asset classes are correcting, then it makes all the more sense really where you're going to put your money.
This time around, because this has emanated in China, which you write contributes to 15% of the world's GDP. Is the impact that much more grave as compared to back in the mid 2000s when it was hit by SARS? At the time, China contributed just 4% of the world's GDP.
Experts that we were speaking to point this out as a very, very real concern. The fact that you have on one side, it's not just China. Of course, China is there, but you have to take the mix of China, South Korea, and Japan, which have extremely strong supply chain linkages. And when you look at all the three economies getting disrupted in a major way, then really we are talking about big numbers. You're talking about products across the globe, which either would get hit by, lack of exports or these economies not importing anymore. You are talking about a situation which is getting disrupted a lot more than it was in SARS. And also the supply chain linkages were not so strong. So yes, it seemed to be a concern at that time. The fact that social media today is so strong, internet has it's across the globe virtually, all of that makes news travel faster. So really coronavirus, the global economy, all of this, even factors like the central banks across the globe taking action, all of this means that investors are aware on a day-to-day basis really what's happening across the globe, and which is where it makes coronavirus all the more deadly.
Right, and also the stock markets from everywhere have tanked. So during these times, where is it that the retail investor should park his or her savings? In a time when the interest rates in India are low, what is it that would be a prudent thing to do?
What we're trying to bring across in our cover story and in the entire investment special is 2-3 strong themes. One is that be ready for more pain. I think investors have to understand that you could very well see a scenario where there could be more pain ahead, both in terms of economic slowdown, volatility in equities, and the coronavirus outbreak, the impact of that. In that scenario, investors need to stay calm also. Every emergency situation has shown that investors tend to either pull out of equities and stay strong in cash in their bank account, the bank deposit, or look at some kind of a government security or any kind of a debt instrument. But as you said, in a scenario where interest rates are low, the debt instrument is not going to give you too much. So typically then your money does go back into gold. And that's what we have already seen. Our story does talk about that very strongly, that gold has already seen a 10% jump this year to date in the Mumbai markets. And it's quite likely to escalate even more.
Gold prices in India are strongly linked with the international gold prices, which are at a near 7-year high. Today, I think, Salil, you also write how people can pick small quantities of digital gold online.
So there are companies we have spoken to which sell this gold. If you buy this gold in a physical form, the gold is stored in a locker actually, but the process of buying takes place digitally. It's very unique. What happens is, unlike when you buy gold in the form of jewelry, as jewelry demand, it is price elastic. So typically what I mean here is that, as prices go up, the demand and the quantum of gold that you buy goes down. That's typically our the behavior of the average Indian and Asian. But in this case, when we talk about gold as an investment, as the price goes up, people tend to buy more. It's like stock. They start believing that yes, gold will see further appreciation, so let me buy it now, let me buy more, and then they sell it at a higher price. So in that case, what we have seen, and this is a point also which we have raised in one of our other stories, which talks about SIPs. The entire 2 months now of uncertainty, what it has thrown up oddly is a certain amount of maturity. What we have seen is that SIP volumes have been going up regardless of the volatility, and that is something that investors should keep in mind. But what we have seen over the last 2 to 3 years is that inflows through SIPs have grown by an average of 1,000 crore in the last 3 years. So from 6,000 crore per month in 2017, they are now 8,000 crore in 2019.
And today you also have avenues that weren't present about a decade ago, or at least it is far more easier to, let's say, invest money in overseas stocks, where one rule allows you to have $250,000 per person per year, and you have platforms that allow you to quickly purchase stocks, which wasn't really the case until a few years ago.
Yes, there are several platforms which offer you this process. The advantage is really that, today's investors are definitely keeping a closer look at really what's happening in the US. We are talking right now mostly of the US and of course, some of the equities in UK. And the fact that, there's more transparency, the fact that there's a certain amount of confidence that the SEC would offer, in terms of governance of these stocks and the kind of management that corporates have. It gives investors, a particular set of investors, like a lot of confidence. They feel that, okay, I may not want to invest in Indian equities, which have not offered them great returns, but I could do it. I could do it through index funds, or I could do it through some of these other platforms. And the advantage is that really, you are looking at a phase when US has seen phenomenal returns in terms of the stock markets, in recent times. It's seeing one of its finest phases, even in terms of job opportunities. So really, the economy in those terms, as far as US is concerned, couldn't have been better. Those are things which investors will start looking at.
In other words, we need to keep our eyes open to opportunities that might not just be in India. And also, as you mentioned previously in the podcast, you could also look at it as an opportunity to invest. And one statistic that backs it up is that of a study by ICICI Direct that you write about, where on 6 out of 9 occasions when the market had corrected by more than 10%, all the losses were recouped within the subsequent 2 months, which is rather reassuring.
Absolutely, absolutely. So even when you look at the opportunity that it provides you today, in terms of extreme uncertainty, extreme volatility, so nervousness about where will US stocks go, or where will emerging economies go, and how much will coronavirus impact economies in this entire scenario, you will find that, surprisingly, the stock markets do rebound quickly. And that's something that we saw post the Lehman collapse, and the global meltdown in 2008. Those who stayed invested over a period in 2009 have probably reaped the best returns. It's something that even regular SIP investors talk about, that if they had stayed invested, right through from 2009 onwards, their returns would have been much smarter. It's something which goes back to that underlying theme of staying invested, not panicking, and obviously looking at stocks which have, or companies which have strong governance, a balance sheet which is not too debt laden, and a good business model.
And on that, it's not so much doom and gloom note. It's time to wrap it up. So thank you very much for your
Thank
time on
you,
this
Abhishek.
podcast. Thanks, Salil. And all your listeners, you can get this podcast on ForbesIndia.com and on iTunes. And to have someone call you for a Forbes India subscription, message Forbes to 51818.